When trading futures, contracts come in different sizes, and two common types are emini contracts and micro contracts. An emini contract represents a standard-sized futures contract that tracks the price movement of an underlying market, such as a stock index. These contracts were designed to provide access to futures markets with smaller size than older full-sized contracts, while still offering significant market exposure. Before moving forward, please review the risk disclosures shown on screen. Understanding the risks involved is essential before learning about trading. Micro contracts are a smaller version of emini contracts. They are structured to move in the same way as their corresponding emini contract, but at a reduced contract size, meaning each price movement has a smaller financial impact. In most markets, one micro contract is equivalent to 1/10 of the value of one emini contract. This means that for the same price movement, the profit or loss of a micro contract is approximately 10 times smaller than that of an emini contract. The main difference between emini and micro contracts is contract size and risk. Because emini contracts have a larger value per price movement, they require more margin and involve greater potential gains and losses compared to micro contracts. Micro contracts allow traders to participate in the same markets with lower capital requirements and more precise risk control. This makes them useful for beginners, for smaller accounts, or for traders who want to scale position size gradually. Both emini and micro contracts are traded on regulated exchanges and follow the same trading rules, pricing structure, and market behavior. The difference is not how the market moves, but how much each price movement affects the trading account. Choosing between emini and micro contracts depends on factors such as account size, risk tolerance, and experience level. Understanding contract specifications is essential before placing any trade. This content is provided for educational purposes only and should not be considered financial advice. Trading involves significant risk and is not suitable for everyone.